This is how I use time and AI to my advantage when trading options. In this video, you will see everything: the indicators that I use, which stock I trade, and how exactly the trades are executed. You will learn about credit spreads and why it is my favorite strategy when trading options. So let's start by looking at the chart. I have here TradingView.com. You can subscribe, it's for free for 2 charts at a time, and you actually don't need more than those 2 charts. It's a very simple setup. So on the left hand here you have the VIX, and the VIX here stands for volatility index. It's how volatile the market is. I have it on the 3 minutes and time frame, and then I have the bars set here, not lines but bars, and we have the indicator. I will tell you later where you get this indicator and which stock to trade and so forth. So let's have a look at this. You have to understand that I use it like this when the VIX, when I get this indicator here turning down, that means there's a good chance that the market will go up, and vice versa. If it's the other way around, you get a green, then it's actually the market will go down. So it's the increase of volatility will indicate that the market will go down, so you will look for short trades, and the decrease of the volatility would indicate that the market with a good chance will go up. And on the right side here I have the stocks that I am interested in. In this case it's DraftKings. It really doesn't matter right now. I just want to show you which one I'm using. So what I actually basically do is I wait here on which side the market will go, and once I see this indicator or this indicator, then I pick the stocks that are beforehand prepared either to go long or either to go short. And this is in a nutshell how it is. Now let's talk about an option. What is an option? And for that I have this figure here. No, this is time decay. I have another one, this one. Don't look at those down here, just focus on this. We start with the call option here. So a stock option is a contract between 2 parties that gives the buyer the right to buy or sell an underlying stock, or actually 100 stocks, and at a predetermined price and within a specific time period. A seller of the stock option is called an option writer, where the seller is paid a premium from the contract purchased by the buyer. And let's understand that what you do is you buy this option, and what you hope is the price goes beyond the strike price. So here you have the stock price, and let's say you buy a call option, which is a long position, and what you hope is the price go further up beyond the strike price, and in that case you make profit. If the price stays under the strike price at the expiration day, then you will lose all the premium here, and the seller will get the premium. So as you can see that the seller have actually a lot of advantage over you as a buyer. Why? Because we have something called time decay. You pay for the premium, but the value of the premiums fall, or the value of the option falls as soon as you get into the expiration time. And that means that an option or yes, an option that you have bought could actually lose its value even when it goes beyond the strike price, because a lot of time has passed. And this is how you can get the advantage of time. This is how you get advantage of time when you sell an option. So we want, or you want, to be a seller of an option, not a buyer of an option, because that means that, let me show you something here. Even let's say you sell an option at 28.22 here, just for having a price. So you sell the option up here, or you sell an option. Someone buys it. Someone buys your option. But as long as it stays under the strike price, you will make money at the end. And that is great. And that is what we're talking about, is taking advantage of the time. So now you have advantage. You analyze the stock, you know which direction it's going, but you also have the advantage using time. And that is what I tried to explain in the beginning, or what I talked about at the beginning, how you can take an option or the time in your advantage. Now that we talked about selling an option or writing an option, which is a good thing, so we can have the time to work for us or for you, there is a big disadvantage, or there's like a stop loss, because it requires a lot of capital, and the broker will not let you write an option unless you have a lot of capital in your account. And that is why there is a solution for it, and that we call is credit spread. So in a credit spread, what you do is you sell an expensive option, and then at the same time you buy a less expensive option. And that means that even if you lose money, you don't lose everything, because the risk will be controlled. And that is exactly what I'm going to explain it now. Now we're looking at something called an option chain. And as you can see, the option chain here, I know it takes a lot of time to, there's a lot of things to look at, but I'll try to make it as simple as possible. You can see here the strike price, and you can see it's increasing. So here the calls, and here the puts. On the left side, the calls are when you are selling. That means you're hoping that the price stay at the same place or goes down. But on the other hand, puts means that if you sell puts, then you hope the price goes up. So we just focus on calls here, all right, on that option change for the July 22. Let's say we want to sell an option at the strike price of 12. That means that we don't want the price to increase over 12 at the expiration time. So what you do is just click here and see you are selling one contract for this price here, and as you can see, the max profit is 26, but actually the max loss is infinite, because imagine that you sell an option and then next day there's some kind of news, and the price of the stock price shoots up, goes up to, let's say, 100. So you really it's infinite. You can lose everything, and that's why the broker don't want to take a risk like this if you don't have enough money in your account. But let's have a look at it curve wise. So if I go up here to the curve, now we were at table, let's go to the curve, and you see here how it looks. The price, if the price stays under 11, you at the expiration time you will be making profit, the 26 max profit. But as you can see here, if the price increases before the expiration time, you will see that it's you'll just continue to lose money. So how do we do it? As we talk about credit spreads, and it's a very easy way to do it. What you do is you yeah, this is also how it looks when it's closed down, but I will clear it. And what I do, I'll go back to the table. Now look up here. We always want to short. And what do you want to short? We want to short a call, and it's a vertical spread. And now let's see how it looks like. Can you see that? We are selling an expensive contract. Excuse me, we are selling an expensive contract and buying a cheaper one. So let's see how it looks on the curve. Here it looks in the curve. Let me minimize this. As you see, now you have max loss of minus 30 and max profit of 18. Well, the probability of this getting to 18 is 65%. But this is not the way to trade. What I do is I usually go up here and have a look, and here try to make it 50-50 or like equal. So what I do is just drag this down, oops, and drag this one down, and then you can see here that it increases max profit 25, max loss 20. Okay, it just changed. But this is how I like always to trade around the at the money or the price right now. That doesn't mean that you could go out, you could close this trade, both of these trades, you could close them before it reaches minus 26. So that doesn't mean that you have to wait until you can close a position before the expiration day. And that's perfectly all right. But I like to run my all the way up to the expiration. And the reason why is that I like to take advantage of this figure, which is time decay, because as you can see, it's not linear. It doesn't fall like linear like this. It falls like it accelerates when you get to the expiration time, and that's perfect as a seller. That's perfect for a seller. That it increases, the time decay increases the value of the contract. Now let me see it again. Let's repeat it one more time. What I'm doing is that I'm clearing this. I'm going back to tables. Now what I do is I simply go up here. I choose I want to make a credit spread. That means I'm going to short it. I'm going to short a call, and it's a vertical spread, and I just say go, and I drag and drop right down to here. So now that you understand what is credit spread and what's an option and how to trade it, I'm gonna tell you where I get this indicator and how I get the stock that I want to choose. What I do is, there we go, and yes, see, this is what I got down here. Oh yeah, here is the free indicator. You get it from the website, and this is updated daily. And you can see the yes, let me get in here. All right, here you see the when it has this oh yeah, this, let me go back here. This website uses AI to find strike option or unusual options trade. This means the big boys have or the institution bought, and you have to know that actually it's options that determine the price of the stock. So what they do, the AI goes in and they go in and find out if there was unusual behavior on a specific option play. So now let's go back and see how it looks in there. Oh yeah, let me click this one. Good. So you see that when it came out, you see this the symbol. You see if it's a put or a call option. But that means that this put means that they expect the price to go down, and call they expect the price to go up. And this is the expiration date, and this is the strike price, and this is how I do it. So what I do is I'll take those strike price, those symbol, and then I go and analyze. Let me show you what I mean. What I do is I start the day by, then I put the indicator here. The symbols here, and once I find the stock that I'm interested in, then I have them ready. As soon as I can see any indication either going up or going down, I can just click on those, click on the symbol, and as you can see, it changes immediately down here, and I can choose the expiration date, and then I just use go, put it down where I want it to, and then review and send, and execute the trade. Now I don't want to do that, but I just wanted to show you how it is done. The last thing I want to talk about here is how you manage those positions. How do you make your portfolio not in risk? And what I actually do is, let's say that you sold a vertical spread here. Down here. This is the VIX. So let's say you sold a vertical spread here, but later you get an indication that the market is going to go up. Then you go back and find something, or then you go back and find the stock that you prepared and you think is gonna go up, because you take those here, but you don't just take it blindly. You have to look at the stock the graphs. How does the stock price, does it look bullish or is it on its way down, right? Because it can go a long time before the expiration time, right? So I usually buy a stock or sell a vertical call that expires within 1 week or maximum 1 week, or maybe less than a week. But you don't want to wait by the expiration time until like next year or something. No, you wanna use the next week, and that's, it's gonna go there up sometimes according to this list here. But you have to look at the price or the graph itself to determine how does it look. Does it look bullish? Does the graph look bullish, or it doesn't look bullish? And what you can do is you can go to the history of all the trades, and you can just take one by one and analyze how does it look, how did it look, how did the stock behave when it came on this list, right? So once you have figured that out, so my suggestion to you, which I do, is just when you have an indication that the market is going up, then you sell a put option or a put credit. You make a put credit spread. It's going down, then you make a call credit spread. The idea is you try to balance. If you have one credit spread going long or going up, then you should have another one going down. And that's why if the market turn on you, then you have balance of the portfolio. Try not to have too many calls and too few puts, or too few puts and too many calls. Try to balance the portfolio. And that's why, and in that way you can always have a balanced portfolio. I'm repeating myself, but that's what I mean is try to have calls and puts, the same amount of calls as puts, right? And that's what we call, that's what you can call it's some kind of art, right? How to balance a portfolio, how to make it less risky. That's the art within trading. Well, I hope this was helpful for you, and yes, I wish you good luck and happy trading.